Hello, and today is the 29th of March, nearly quarter end, month end. We had an interesting week last week, didn't we, Andy? Equities again fell apart Thursday and Friday. They just could not sustain gains. What do you think is going on at the moment? What is the big macro backdrop? Because we're not getting any weak data as such. We are just in the middle of a growth scare and no prospect of getting out of one, but the data still isn't supporting it. What is going on?
Yeah, it seems clear we're in a growth scare. Asset prices are acting like that. There is going from the front end of the curve where three cuts are now priced in for 2025, despite the Fed continuing to say that they plan on two or possibly less and think the economy is in a good place, and equities are selling off, and that's consistent with a growth scare. So yeah, it seems like there is a concern of falling growth. Now, this is something we've been saying we expected for months now, but it's now playing out in markets and continues to play out on markets. And so we have to firstly say, why would there be a growth scare? And I guess the first thing is the Fed has gotten significantly more hawkish and they're on pause, and they continue to reiterate that view. And part of that is because of policy uncertainty, which is broadly anti growth. We've seen nothing but expenditure cuts and tariffs and immigration, and all of those things are anti growth. And because of the tariffs and the immigration, it's inflationary. So those combination of things are scaring markets, and I think they should be scared. Now, that said, the question is how scared? Because we've had a meaningful move in equities down 10-ish% now. And that would, in most scenarios where you have a modest growth slowdown, that would be a pretty meaningful correction. But I think that it's also clear that while growth is slowing, equity prices had been extremely optimistic on growth. And so this correction to me is not reflective of an actual growth slowdown. And so now the question will become, when will the data turn over, or maybe it won't?
Right, because certainly the data is not responding as yet. The first opportunity we have is NFP next Friday, but I still think that's probably still too early. And as you say, rates are reflecting somewhere in the middle of what is probably going to happen. My own feeling is that either we get out of this growth scare without too much of a slowdown, in which case I don't see why the Fed should do anything at all this year in terms of moving rates, or we do fall into a shallow recession, in which case I think they'll probably do twice as much as is priced into the market. So where we are is disequilibrium. And I personally think that equities probably haven't retraced enough yet as well. I seem to be in the same camp as you, because really equities on the quarter, the SPY is only down 5%. And 5% retracement on such a potentially significant bunch of policy changes, and you said tariffs and everything else that could be hitting us in the next few months, could well not be enough. So, but it is US equities that are being repriced. All the other equities all around the world have had pretty decent returns for the quarter. You've got Europe up double digits, you have Japan up 3%, you have the rest of the world without US up how much? About 7%. So if you say the rest of the world is up 7% and the US is down 4%, well, that's a meaningful swing, isn't it? And probably that kind of behavior continues during the second quarter until and unless we get a complete reversal of the current administration's policies. Do you think that is realistic?
I don't. The concern for me isn't whether the policymakers will shift, given what, as you said, a shallow sell-off in equities and no sign in the data of weakness. What's more, the thing that I think would be, it's hard to say bullish, but in terms of policy, but the thing that can save us in terms of this slowdown is if somehow the Trump administration wasn't able, like legally able, to do what it wants. And that in particular is around expenditure cuts, but also possibly tariffs. A lot of the pushback so far in the tariff information we got last week, and let's be clear, what happened last week was, again, data relatively okay, auctions relatively okay, and tariff news on Wednesday really turned the market, and that was the auto tariffs. And that just continued throughout the rest of the week, with, despite the European Union saying they have a list of concessions that they're going to offer, and Mark Carney from Canada saying, along with Trump, saying that they had constructive conversations, and Trump using terms like that our tariffs will be nice and fair and lenient. All of that was pretty much ignored once the market started coming down. So when you think about that, you say, well, why? It's possible that some of the existing treaties, including the Atlantic Treaty and the US, Canada, Mexico trade agreement, all are reversed legally and prevent Trump from doing what he wants. But absent that, I don't see any lack of commitment to make the changes the administration is making. And those are anti-growth and will show up in the data eventually. And as of yet, have only showed up in survey data and some retail data, retail sales data particularly. And so we'll see. I would expect, though, that as we look forward, we have NFP, which we'll talk about the events of next week in a moment, but we also have a earnings period, which starts in the later half of April and goes into early May. And I cannot imagine a better opportunity for the U.S. corporation to guide down its outlook. It's an easy story. There's great,
Ideal.
Fed is telling the story. There's great uncertainty. Companies that are struggling are going to really guide down because they're already struggling, and those that aren't struggling have no risk, no at all, of guiding down so that they can beat come the second half of the year.
No, I absolutely agree with that. I don't think there's a single CFO out there who is not going to take the opportunity to make his balance sheet look as bad as possible, i.e. throw everything, the kitchen sink at it, so that he can beat and beat comfortably in this period of uncertainty. And nobody will be looking to beat in Q2, they'll be looking to beat in Q3. So that is when really they will try to beat. So I think we still have several months during which equity prices can make new lows. I look a lot at what insiders are doing, and company insiders are still selling. There isn't any sign that they're beginning to buy as yet, which tells me that they're going to guide lower, and therefore that US equities are still probably the least attractive place to be in the equity space, and will continue to be so for the foreseeable future. Now, as to what happens next week, Liberation Day on Wednesday, do you have any expectations that we will have any more clarity as to what happens after Liberation Day?
Absolutely not. I think well, let's just step back and say it's possible that the tariffs are meaningfully less than expected. It's not likely, but it's possible. And that may generate some sort of relief. It's possible tariffs will be exactly as expected, and that may generate some relief. And even frankly, it's possible that they're worse than expected. And that will cause the market to sell off, but then generate relief. And the relief would come from the idea that the news has occurred. And the fear of the news generates a relief rally in stocks and perhaps a relief sell off in bonds. But that would imply that somehow there's a cathartic end to what the tariff debate is going to happen. I don't see it that way at all. I see this as not the end of the beginning of the end of our discussion about tariffs, or the absolute end of tariffs. I think it's the beginning of tariffs, or the end of the beginning, I guess is the better way of saying it. And I think what will happen is we will unilaterally put out our tariffs, some of which we've leaked, some of which we've discussed with our trading counterparties, but not the full gamut. And then, like we saw a completely out of the blue extra auto tariff, and at the end of the day on Friday, an extra pharmaceutical tariff was hinted at, there'll also be the response and the counter response and the retaliation and the escalation. And this is an ongoing thing. Why is this ongoing? Why is this? Because the United States, for many decades, has lost manufacturing jobs to the rest of the world and has put at risk its national security, which became quite evident during COVID, by offshoring its productive capacity. And so if you believe, and it's fair to say he may cave on this, but if you believe that the Trump agenda is to shift some of the jobs in services in the United States, because we're not going to manufacture more workers, shift some of the jobs in services and retail and things like that to manufacturing, and improve, which presumably has more attractive wages and longevity. And it's the old American dream jobs of manufacturing that have gone away. If you believe that as a motivation, which I think it is, and you believe that the principal motivation is a national security motivation to onshore our supply chain so that we are less at risk to allies and enemies and pestilence and war. And if you believe that that's the agenda, that doesn't happen overnight. That's a multi-year plan. And so I think it's the end of the beginning on Liberation Day, and we will be dealing with the reshaping of global trade for years to come.
What are the implications for investments in that case? Do you think that basically what you're saying is that US equities have started a long period of underperformance relative to the rest of the world, and that probably US bonds have started a period of outperformance against foreign bonds, especially developed markets kind of thing? So you're talking about the spread between Europe and the US coming in terms of bond prices, and you are talking about the valuation, the multiples on equities in the US coming down. So it's no longer in the 20s, but it might be in the high teens.
More sure. That's a very normal outcome. We can be doomish, and we're not. Let's be clear. We think equities are still a sell the rally sort of market. Doomish is much, much worse than anything we're discussing here. We're talking about a slice of the multiple, just a multiple point or two, and that's it. Some of that, maybe it's a slice of one multiple point and a degrading of our earnings growth by a few percent that could take the equity market down 10%. We're not talking about disaster here. Nonetheless, the trend that we're talking about is one in which the US invests in, and foreigners invest in manufacturing capacity, squeeze jobs tighter as the transition from service to manufacturing jobs increases. And because of that transition period, our productivity in these new enterprises, number one, is already less efficient than offshore alternatives without a major currency change. And because it's less efficient, we get less production. So that's a, I hate to use this term because people use it wrong, and I'll be using it wrong. That's a stagflationary outcome, and that's very bad for assets. Bonds can do okay, but not great, and equities hate that. And the conditions elsewhere are disinflationary because all of a sudden they're going to have a ton of production they can't move to the United States. So goods will fall there. And anti-growth, but offset by what we've now seen as significant fiscal stimulus coming from in Europe and in China, which can make their equity markets do pretty well, particularly if the monetary conditions in those countries remain relatively easy, which they are in China, Japan, and most recently in Europe. So those are pretty good conditions for stocks in Europe, bonds in the United States, and pretty bad conditions for stocks in the United States and bonds in the rest of the world. And so the question is, what do we do today? So what do we think?
What do we think about what? About what we're going to do?
What we just said about European bonds, US bonds, European stocks, US stocks. This transition that we're talking about, this multi-year reshaping of global trade has long-term investment implications, which we just mentioned. Better US buyer of bonds, better seller of US stocks, better buyer of European rest of world stocks, better seller of rest of world bonds. But it's a multi-year trend. Next week, we have two things happening. We have the tariff, which we just described as being the end of the beginning of a long trade war, and NFP, which for all intents and purposes is likely going to be okay.
Right. But the risks to it are very much skewed to the downside, aren't they?
Yeah.
Because if NFP is as expected, everybody is going to say, well, so what? The weakness of the data will come in next month. It's too early now. But should we get any weakness in NFP? And I don't see why we should, because weekly payrolls have been steady in line. So that is low odds. Then everybody is going to sell US equities like crazy. If NFP is weak, they'll say, here we are. This is the confirmation of the growth scare. And it's no longer just a growth scare, it's possibly recession. So you're going to have a pretty nasty day on Friday if that were to happen. I think the odds of it are very low. But the implication of all being saying are very clear. The trend in returns from Q1 is probably going to continue in Q2 and Q3, which basically means that the worst performing asset is likely to be US equities. The best performing asset is probably likely to be a little bit of duration in the US rather than anywhere else. And things like gold and rest of the world equities. That is where the
it's time to get in rest of the world equities at this stage. I think that trend has moved a long way already.
I think that what you want to do is you want to sell rallies in US equities, and then you want to buy the big dip in rest of the world equities.
Yeah,
I agree with that. That is the kind, you're in a trading environment, unfortunately. And also one in which you cannot rely on bond returns in your mix to make up for the losses in US equities. It's just not going to happen. So on any rally, you need to reduce US stocks. when you get a big dip, you need to buy some rest of the world equities to bring yourself back up to a 30% allocation in equities overall. So I will go through this later on, but our allocation is too high at the moment to US equities. On rallies, we will reduce it substantially and then use a dip to buy rest of the world equities and
Sounds
come
good.
back to a 35% allocation. But one has to be far more active than we have been so far this year.
Sounds good.
Excellent. Speak to you next week, Andy.
See ya.